So I'm joined now by Gbemi Alonge, economic analyst and founder Nourish Box, to help us review some of our top headlines in more detail. Thanks for coming on the show, Gbemi. Great to see you. So I want to first start about Japanese Prime Minister Takaichi announcing and unveiling a $135 billion stimulus package. That is humongous, right? Is this excessive or is it justified?
So depending on how you look at it, really, the Japanese economy has been through a very tough year and tough couple of years since 2020. You know, labor is more difficult to find, so that means it's more expensive. Imports are more expensive, and obviously the elephant in the room is the U.S. tariffs. And even though Japan managed to get a deal with the U.S., so they promised to invest about $550 billion in the U.S. economy. That's, by the time you think about that, plus this new stimulus bill is even fatter and more expensive. Yeah. But regardless of that, their automobiles will still be charged a 15% tariff going into the U.S., and that's pretty expensive, and that has really affected them. Along with that, you also have a situation where consumer demand has also reduced significantly, partly because energy prices have increased. You know, there was a subsidy that was implemented in 2023 that has now expired, which will then be reintroduced with this new stimulus bill. And so you have a situation where the economy is just facing very tough situations. Inflation has been at 3% for a couple of months, or a year actually. Higher than the benchmark rate or the target rate of 2%. So it seems the economy does need some push. It needs some boost at this point, because they've tried to do it a few times, but it's not. So I think in a way, looking from the outside in, it's somewhat justified, but the government would need to keep an eye on that, so that it doesn't worsen inflation.
Indeed, and I like the mention of the sort of military side or the geopolitical side, because it's actually bundled the military element with the economic element. So it's actually acknowledging that, security has become a permanent, economic concern, giving tensions with China and North Korea. Anyway, Bitcoin. Look, we've had this debate about Bitcoin, whether it is a sustainable long-term store of value or whether it's just purely in the speculative asset territory. What does this new market route really tell us about the future of Bitcoin?
It's very volatile.
Yeah,
it's
you don't say.
Volatile, like trillions of dollars lost in just a few days. That's if that tells the story itself. Like you don't. And also it's because there isn't really a trend. There wasn't any big thing that happened that caused like a wave or like an exit and everything. So that even makes it more, that just tells the story, right?
Indeed.
Without a significant event, if you're seeing this much loss of value, then it's not a store of value. Store of values are typically more sustainable, more predictable assets, like gold, exactly. Or even like government securities, where you kind of see what happens that then fuels or drives a certain action by the government. So, for example, the U.S. seeing inflation sort of rise and then predicting the U.S. Interest rates going higher, or for rate cuts not coming anytime soon. There's a predictability, right, with usual stores of value, but in this case, nothing significant happens.
It's always like a vicious cycle, because you're seeing this cascading liquidations from those who have overexposed positions. So it just keeps, only God knows where this will stop. But let's talk about S&P, Standard & Poor's Global, having to defend, yet again, African sovereign ratings. Such a controversial issue. We've also heard about Africa wanting to develop its own sovereign ratings body. What do you make of this latest defense?
So they'll have to keep defending because you have a situation where African governments, it's a self-fulfilling prophecy. There's this rating that sort of prevents African governments from approaching commercial markets, or makes it very prohibitive. Either the interest rates are too high, or the governments are unable to. I mean, interest rates are high, but because of the deep liquidity of these markets, some governments they feel like they have no choice but to go there, right? And these funds come without conditions that the typical multilateral loans will come with. So they approach the markets, and then because it's so high, they're then unable to pay back, and then
the ratings are causing the same fiscal deterioration
that
they're trying to
that they claim to be trying to ward off. So you can, but then again, African governments are not exactly.
They're not exactly
innocent.
Blameless, yes. So I get that. Right. We need to look at the other side of the
so
coin.
We also need to look at it. But then I think if... I welcome, the African credit rating body. It allows for comparison because the big three, apart from Standard & Poor's, like the big three, Fitch, Moody's, they all do the same thing, right? So usually their ratings are similar. But then if you have an African, they've been clamoring about how, they don't look at the peculiarities of each country, the raw materials that the minerals that these countries have and everything, even though those minerals are sometimes exploited at the detriment of the people and they're used as securities for some loans, some bilateral loans, and that's a whole can of worms, right? But then you have it's good that this comparison is coming. So if there is an African credit rating agency, then we can compare.
Exactly.
Then the commercial lenders who want to lend to Africa can then compare and say, okay, even if S&P is saying this, what are the people on the ground saying? Because sometimes the analysts that put together these ratings don't even live on the continent, so they're.
Or they do short-term visits.
Exactly. Right? Yes. And is the short-term visits enough to actually judge the landscape of things?
Fair point. And I think it's really a case of maybe not having foreign ratings replace the African ones, but be considered side by side, as you mentioned.
It's complementary to the existing big three.
Yes. Yeah. Okay, so 2.03 trillion naira in investment inflows. Since 2007, we haven't witnessed such massive thing. And despite the short-term volatility you're seeing recently over policy announcements. What does this tell us overall? This seems to be a response specifically to the macro policy environment, some of the key reforms we saw early on in the president's term. So tell us a bit about the dynamics we're seeing here.
So I think on the one hand, it signals, investor confidence in the economy, but more importantly, investor confidence in the CBN. Okay. And in the foreign exchange reserves. So our foreign exchange reserves increased yet again to $43 billion. So for $43 billion. So that signals, what we're seeing now is investors actually showing that, okay, if I put my money in Nigeria, I can take it out. There's also the high returns. Interest rates have been very high and very attractive. So Nigerian securities are very attractive. Okay. Nigerian businesses are also doing very well. Banks are recording profits. And, it just signals that, yes, indeed, Nigeria is ready for business. But also, more importantly, investors can actually take their money out. They believe that they can take their money out when they need to.
But I have to ask you, are we actually maybe inadvertently celebrating hot money here? That can evaporate overnight,
of course,
rather than long-term capital. So yes, while it's a signal, what are the risks of that imbalance or that sort of disruption if there's a major shock? Not be a domestic policy shock, right?
So it's hot money. It's hot money, and African economies are always at risk of this. So. Hot money in the sense that investors can actually... what we're seeing is, they're putting their money in because they believe they can take it out, and they can actually take it out at any time. What we would love to see more of, and I feel like this is what the federal government has been pushing for with all the roadshows and things that they've been doing in the past year or more, is more FDIs. Yes. However, we are now seeing more deterrence to these FDIs, security challenges that just... anyone who sees the news wouldn't want to put their money in if there's a risk of kidnapping and all of that. So they'll need to actually improve on that so that the hot money can actually then seep into more foreign direct investments, which is more sustainable and more has a higher multiplier effect on the economy.
And of course, the proportion of foreign to domestic is also maybe a buffer against such
so
volatility.
Over 80% of the market is still funded by domestic investors and institutional investors as well. Make up a higher proportion
than retail,
which is very
very interesting.
Puts us in a comfortable place.
We've run out of time. Thank you so much. Great chatting with you. Love your commentary. So cool, composed, calm and measured. Thank you. Thanks so much, Gbemi Alonge.
Thanks for having me.
Great.